Good morning. Welcome to the B.F. Anderson Technical Report for October the 13th. Guggenheim's Minard says Fed won't stop raising rates until something breaks. Well, it's kind of an oxymoron because when you've got inflation this high, I think things are already broken. So basically what I've got here is a graph of the Treasury Inflation Protected Bond Fund, and you can see here that even with the safety of government bonds, you can see a tremendous drop in this due to the fact that interest rates continue to head higher. Now, back in history, Paul Volcker was given the position of coming in 1979 when the Fed funds rate around that time was, around, it looks like to me, about 10% in that rough area. He then proceeded to raise the Fed funds rate to over 20%. So inflation is like a train running at you. You've got to deal with it. And so basically what happened, though, was that once the market discounted that that rates had gone as high as they were going to go, the market took off in 1982. We did have a recession in 1980, but then the stock market took off, and as you can see here, interest rates started to trend down because Volcker basically effectively ended inflation or killed it. But, also you have to remember in 1982, we also had the development of Microsoft and the personal computer. That had a lot to do with the bull market. Now, just to kind of take a snapshot of where we are, the Nasdaq continues in a downtrend. Now, remember, a downtrend is defined where you make a low and then you make a lower high, and now we're making a lower low. So the downtrend continues. So not good. Now, in the S&P, same thing. We've got a downtrend continuing. Also noticed this morning that the inflation numbers came out. They weren't good. I noticed here that Apple has broken down to 135, which we'll talk about. Now, I do have one positive to share with you. This is the Nasdaq breaking to a fresh low. However, the small caps did not break to a fresh low, and the mid caps did not break to a fresh low. So that's what we call a divergence. It's a positive divergence. In fact, I can remember back in 2009 when the market made a bottom in March, that was one of the things you had to notice. Now, on the aggression index, pretty much making a fresh low, resuming the downtrend. Again, what we're looking at here is growth stocks compared to consumer staples. And basically, we need this line to turn and start getting into an uptrend. Not yet, not there yet. Interest rates continue to stay in an uptrend, have not gotten back above 4%, but close. Oil prices somewhat in a downtrend. However, we had a little bit of a rally in here. Financial stocks continue to have trouble. Financial stocks, meaning banks, insurance companies, continue to be in a downtrend. Number of new lows continuing to stay elevated. However, we're getting fewer new lows as the market makes new lows, which is somewhat of, again, another divergence where, the sellers, what we're looking for is where the sellers run out of steam and finally, hopefully, dry up. Now, back to interest rates. This is that high yield corporate bond fund. It's a junk bond fund, which I'm keeping a very close eye on. You can see here, just kind of looking back at history, where the market made lows, so did the bond fund. It made a low and then started an uptrend. Well, it continues to come down. It continues to be in a downtrend. So the message here is stay cautious, keep your powder dry, have a lot of cash. If you got stocks in your portfolio that are not acting right, then you need to kind of maybe lighten up on them. This is trend strength. We're still at zero. In fact, you can see where we're making a fresh low here. This is on the Nasdaq. On the S&P, we're at a trend strength of 0. You can see here continuing to make new lows. This downtrend continues. Volatility index. Well, we always said that, if we can get up into this area here, that could be a sign of capitulation. Capitulation is defined as basically just throwing the towel in. People just finally say, I can't take it anymore, and dump all their stocks. Well, actually, we are starting to kind of see that in the real world right now. We're seeing where a lot of people are starting to capitulate. The yield curve continues to stay down in the minus 40 area, minus 4.0 area, basically saying recession. This is just to show you how difficult this market has been. This is utilities, which is always considered to be very safe high ground. Well, look at this, making a fresh low. The utility stocks are actually getting hammered pretty hard. Now, one thing Jesse Livermore said was that if you can't make money in the leaders, you're going to have trouble making money in anything. And so the leaders of today may not be the leaders of 2 years from now. In other words, the bear market, what it's basically doing is it's cleansing the system. And we're getting companies where their earnings are peaking, their businesses are peaking. They could turn out to be duds. You don't know. But the point, where it gets complicated is, even once the market bottoms and turns back up again, the leadership of the market will be completely different from the past bull market. So on the top 5, let's just kind of see where the action is. Biogen, biotechnology, got a nice gap up here, real big volume, nice gap up. Basically, the gap up failed. You know, anytime you get a gap up, you want to put your stop in at the bottom of the gap. Well, it basically stopped out and is, now going somewhat into a downtrend. I would avoid that. First Solar has been on our list here for a while. Nice solid uptrend, consolidation, however, starting to break down. Needs to hold this 50-day moving average. Kind of doubt it does, but just keep an eye on it. This is Iveric, which is another biotech. You can see here, big gap up pretty much failed. Basically trying to rally again. Very high risk. Would just watch this one. Cheniere Energy, this has been on our list off and on, and basically, big activities down around Corpus Christi, Texas. They're selling the LNG to Europe primarily. Stock, it's not really a proper base. You've got a V formation in here, which I don't particularly care for, but trying to stabilize in here. So again, let's just keep an eye on it. Then last but not least, a company called Revance Therapeutics. You can see here we're seeing a lot of biotech stocks. They tend to act like pharmaceuticals. They tend to act somewhat defensive. However, I would continue just to keep an eye on things. Build your watch list, maintain your cash positions. If you have any questions, please let me know. Thank you very much.